Gold just broke below $5,000 on February 17, 2026, on President's Day, in thin Asia trade, when almost nobody was watching. And here is the number that should alarm every person holding gold right now: $5,595.42. That was gold's all-time high, set just 17 days ago on January 29, 2026. From $5,595 to $4,959, a $636 drop in 17 days. The mainstream media headline says it is because of peace talks and a stronger dollar. That is not the full story. Welcome to the Capital Anchor. I break down what is actually happening in markets while the mainstream media keeps you distracted by headlines. Subscribe right now, because what I am about to show you will completely change how you understand what is happening in gold this week. Let us start with exactly what happened today, February 17, 2026, so you have the full picture. Gold is currently trading at $4,959 per ounce. The daily high was $5,052. Sellers defended that level hard and pushed price back below $5,000. US markets are closed today for President's Day. Chinese markets are still shut for Lunar New Year. That means trading volume is extremely thin right now. Here is what most people do not understand about thin volume sessions. When liquidity dries up, a smaller amount of selling creates a much larger price movement than it normally would. Think of it like a swimming pool versus a bathtub. Drop a bowling ball in a swimming pool and you barely notice. Drop it in a bathtub and the water goes everywhere. Today's gold market is a bathtub, and someone just dropped a bowling ball. That is reason number one why the drop looks more dramatic than it may actually be. Now let us talk about what actually triggered this move, because there are three separate forces all hitting gold simultaneously today. Reason number one is the peace narrative. Russia and Ukraine are in active diplomatic talks. A Gaza ceasefire has held since late 2025. US-China trade tensions have cooled significantly compared to where they stood 6 months ago. Markets are reading all of this together as a reduction in global geopolitical risk, and gold is a crisis asset. When the world feels safer, gold loses one of its core engines. That is not opinion. That is how this metal has behaved for decades. That announcement triggered the single worst day for gold since 1983. Gold crashed 9% in one session. Silver collapsed 31.4%, its worst day since March 1980. Here is why. For months, investors had been piling into gold partly because they feared Trump would install a Fed puppet who would destroy the dollar with endless rate cuts. Warsh, a former Fed governor seen as a credible independent voice, shattered that fear. The dollar surged, gold collapsed. That was the original trigger 2 weeks ago. Gold has been trying to recover since then. It climbed from $4,550 back up to $5,119 by February 11th, but now it is sliding again. Because Warsh's policy direction is still unknown, the FOMC minutes are released this Wednesday, February 18th. Traders are repositioning ahead of that print right now, today. Reason number 3 is the Iran nuclear talks. This is the most counterintuitive driver in today's market, and almost nobody is explaining it correctly. Iran's Foreign Minister Abbas Araghchi arrived in Geneva this week for a second round of nuclear talks with the United States. Iran brought what it called, quote, real ideas for a fair and equitable deal. Meanwhile, the U.S. has dispatched a second aircraft carrier to the region. The Revolutionary Guards conducted naval drills in the Strait of Hormuz just yesterday. So you have maximum military tension happening at the same time as maximum diplomatic activity? The net effect on gold's safe haven premium? The market is pricing the hope of resolution, not the risk of war. That is the Iran paradox right now. More warships, more diplomacy, and gold is falling because the market believes a deal is more likely than a conflict. Now here is the part that should make you think carefully, because what big players are doing is completely different from what this price action suggests. While retail investors are selling gold because of peace headlines and a firmer dollar, here is what institutions are actually saying on the record. Bank of America has set a gold price target of $6,500 per ounce by end of 2026. That was stated just 2 weeks ago, during the sell-off. They did not lower their target, they held it. JP Morgan has a target of $6,000 per ounce by 2028 and a conviction call on gold's multi-year bull market. They did not change their view when gold crashed 9% on January 30th. Wisdomtree's Nitesh Shah called the January 30th crash a, quote, healthy correction, not a structural break. He maintained his year-end target of $5,020. Central banks purchased 863 tons of gold in 2025. They are projected to buy 850 tons in 2026. They are not selling. They are still accumulating at these prices. The World Gold Council's scenario analysis shows gold could rise 15% to 30% in 2026 if geopolitical stress intensifies or global growth slows. Their base case is still constructive. So while you are reading headlines about gold falling because the world is getting safer, the largest institutions on the planet are holding their bullish price targets. While most retail investors are nervous about the breach of $5,000 today, managed money net longs in COMEX gold fell by 17,741 lots last week. Speculators ran for the exit, but the structural buyers, the central banks, the institutional allocators, the sovereign wealth funds, they did not move. That disconnect matters enormously. The speculative money panicked, the patient money stayed. And now here is what most people completely miss, because understanding who is actually driving this market right now changes everything about what comes next. Let us go back in time, because this exact setup has happened before, and knowing what came next tells you everything about where gold is headed. In July 2023, gold pulled back sharply from $1,987 to $1,885 per ounce, a $102 drop in 3 weeks. The reason given: a stronger dollar and easing inflation fears. Every retail investor who sold during that pullback missed the entire rally to $2,787 by October 2024. That is a 47% gain, gone, because they trusted the headline, not the structure. In March 2022, gold dropped 7% in 1 week after the Federal Reserve's first rate hike in 4 years. The narrative was identical to today's narrative: dollar stronger, risk easing, sell gold. Gold then climbed from $1,890 to $2,450 over the following 24 months. The people who understood the fundamentals stayed patient. The people who followed the headlines sold near the bottom. Today's setup rhymes almost perfectly with both of those moments: a sharp sentiment-driven pullback, thin volume amplifying the move, speculators exiting, institutions holding firm. Now let us talk about what has not changed, because the short-term price is not the story. The structural picture is the story. Structural factor number 1. Central bank buying is still running at near record levels. In 2022, central banks bought 1,136 tons of gold. In 2023, they bought 1,037 tons. In 2024, 1,045 tons. In 2025, 863 tons. For consecutive years of central bank buying above 850 tons, that has never happened before in the history of this market, ever. These are not traders. These are governments. They do not buy gold because of a short-term price chart. They buy it because they are restructuring their reserves away from the US dollar. Structural factor number 2. The de-dollarization trend is accelerating. The dollar's share of global central bank reserves was 73% in 2000. By February 2026, it stands at 57.8%. That is a 15 percentage point decline over 26 years. And the pace of that decline is increasing, not slowing down. Every percentage point that leaves the dollar has to go somewhere. A significant portion is going into gold. Structural factor number 3. COMEX gold inventories remain under structural stress. The amount of physical gold available for delivery relative to open contracts is at historically tight levels. In January 2026, the gold lease rate spiked sharply as traders scrambled to move physical metal from London to New York ahead of potential tariffs. That physical tightness does not disappear because of a peace negotiation. Structural factor number 4. The U.S. fiscal position has not improved. The U.S. national debt crossed $36.2 trillion in February 2026. The Congressional Budget Office projects $2 trillion annual deficits through 2030. Long-term dollar debasement does not stop because of 1 week of dollar strength. The structural case for gold is built on a 10-year fiscal trajectory, not a single DXY reading. Now I want to go on the record. Screenshot this. Save this timestamp. Gold will reach $5,800 per ounce by September 30, 2026. Here is exactly why that number is defensible. From its current price of $4,959, that is a 16.9% move. Bank of America is calling $6,500. JP Morgan is at $6,000. Even the conservative wisdomtree target of $5,020 is above current prices. The FOMC minutes on Wednesday, February 18th will be the first near-term catalyst. If they confirm 2 rate cuts in 2026, gold gets its first tailwind back immediately. After that, the next catalyst is the May 2026 Fed chair transition to Kevin Warsh. Markets have already priced the worst-case scenario. Any clarity is net positive for gold. Now let us run the scenarios so you have a complete framework going into the next 3 months. Scenario 1. Probability 55%. The FOMC minutes on Wednesday confirmed 2 rate cuts for 2026. The Iran nuclear deal stalls. Central bank buying continues above 800 tons. Gold recovers to $5,400 by April and builds toward $5,800 by September. Scenario 2. Probability 30%. FOMC minutes come in hawkish. The Fed signals only 1 cut or none for 2026. Dollar strengthens further. Gold consolidates between $4,700 and $5,000 through the first half of 2026 before resuming its uptrend in the third quarter. Scenario 3. Probability 15%. A U.S.-Iran deal is reached. A formal Ukraine ceasefire is signed. The dollar surges on risk on sentiment. Gold drops to $4,400 before finding structural support. Recovery takes until late 2026. Now let us talk about what you should actually do with this information, depending on where you are right now. If you are holding physical gold, understand this: the structure of this market has not broken. You hold an asset that 18 central banks bought aggressively in 2025 and plan to buy again in 2026. Do not make a long-term decision based on a thin volume Monday pullback. If you are trading gold with leverage, today is not a day for aggression. Volume is low. Wednesday's FOMC minutes create binary risk. Wait for the data. Let the market show you direction before adding exposure. If you are sitting on cash on the sidelines, the data shows you have time. Scenario 2 gives you a potential entry anywhere between $4,700 and $5,000. That window may be short. Watch Wednesday first. If you bought gold near the all-time high of $5,595 in late January and you are underwater right now, understand what actually happened. The Warsh nomination triggered a sentiment shock, not a structural break. The institutions that set $6,000 to $6,500 targets did so after that crash. They see what you are holding at a discount. Now here are the 4 specific indicators to watch over the next 60 days. Watch the DXY. The US dollar index is currently at 107.1. If it pushes above 108.5, gold faces additional pressure. If it rolls back below 106, gold gets its next leg higher. Watch the FOMC minutes on Wednesday, February 18th. Specifically watch the language around the pace of future rate cuts. Any mention of accelerating cuts is bullish for gold. Any hawkish surprise is a short-term headwind. Watch COMEX gold inventory levels. If physical deliverable stocks continue declining while open interest stays elevated, the structural squeeze thesis strengthens significantly. Watch central bank purchase data. The World Gold Council releases monthly data with a 6-week lag. The January 2026 report drops in mid-March. If buying stayed above 70 tons for the month, that is a structural confirmation signal. Now I want to tell you about 3 types of people watching this right now. The first type is panicking. They are seeing $5,000 break and they are already calculating their losses. They are about to make a decision based on 1 day of thin volume trading. History shows where that decision usually leads. The second type is frozen. They know something important is happening. They feel the tension between the falling price and the bullish institutional targets. They cannot decide what to do, so they do nothing, which in this case for holders is actually the right instinct. The third type is learning. They watch this video. They understand the seesaw between the dollar and gold. They understand why a day's volume context matters. They know what to watch on Wednesday. They are not reacting. They are preparing. Markets do not destroy wealth. They transfer it. Every time a retail investor panics out of a position based on a headline, that position moves to someone with a longer time horizon and better information. The January 30th crash moved gold from nervous hands to patient hands. Today's thin volume dip below $5,000 is doing the same thing. The question is always the same: which side of that transfer are you on? Gold slipped below $5,000 on February 17, 2026, while almost nobody was watching. Now you know exactly why it happened, what the structure actually looks like, and what to monitor next. If this video gave you clarity that the mainstream coverage did not, hit subscribe. Share this with one person who is panicking about gold right now. They need this more than you do. And drop one comment below. Tell me, are you holding through this, or did you exit? Type either holding or exited in the comments. I read every single one. This is Capital Anchor. I will see you Wednesday after the FOMC minutes drop. This video is for educational purposes only and does not constitute financial advice.